Hi, this is Antoine Harris with Platinum Bridge Wealth Strategies, and many people have been asking me about the prospects for the market given the fact that we're in a rising interest rate environment. So I wanted to talk to you a little bit about that today. Going back to 1971, there have been 9 rate hike cycles. The stock market has been up 8 out of those 9 times. And the reason is simple. Typically, the Federal Reserve is not going to raise interest rates unless we're in a pretty sound economic environment. If they raise rates too soon, then it could throw the economy into a recession. So that same economic environment, that same backdrop, acts as a catalyst for stocks. So as the economy is more robust and growing, that of course that's a favorable environment for stock investing. Now as we look at 4 different categories of stocks, we have companies that pay no dividends at all, companies that actually cut their dividends, companies that do pay a dividend, and then companies that actually are actively growing their dividends over time. That last group, the companies that are growing their dividends systematically over time, tend to do best in a rising rate environment. So as you look at your portfolios, you're going to see investments that we focused on that actually have a track record of paying dividends, but increasing those dividends as well over time. So we're looking out over the next several years. I think that's a good place to be positioned going forward. Now this is a very challenging environment for bonds because as interest rates rise, the value of bonds tends to fall. So we always need core bonds in the portfolio because if the stock market goes down, money tends to flow out of risky assets like stocks and into less risky assets like bonds. It's called a flight to quality. So we're always going to have bonds in the portfolio to help mitigate some of the volatility and act as kind of a ballast against a stock market decline. But in a rising rate environment, we need to be strategic. So you're going to see something in the portfolio called bullet shares. And these bullet shares are basically pools of bonds that have a set maturity date. So as long as you hold a bond until it matures, you get your full principal value back at maturity. Even if that bond principal was volatile in the interim, at maturity you get full payment back. So these are pools of bonds that are designed to be held until they mature, but they're held for a specific year. So for example, I have bullet shares in portfolios that may be maturing in the year 2021, 2022. So you get that diversification of having pools of bonds, but you also have the reliability of having a set maturity date within this bond pool as a way to help mitigate some of that interest rate risk. The next thing that you're going to see in the portfolio are something called floating rate bonds. So these are basically loans to small companies that are using it to buy equipment, etc. Now these loans are resetting every 90 days. So as interest rates increase, the loan pool is resetting in lockstep with the overall market rate, and that also helps to mitigate the interest rate risk in the portfolio. If you have any questions, please let me know. This is Antoine Harris with Platinum Bridge Wealth Strategies, and I'll talk to you soon.